Interest rates in Singapore have fallen by 2.5 percentage points from their peak, and yet most of the Singapore REITs are still either flat or down, while some have even cut their DPUs. So what's going on? And is REITs investing dead? In this video, I'm going to show you exactly why that's happening and why some REITs are unlike the rest. So let's not waste any time and let's jump right in. Okay, in order to understand why even though rates have gone down, REITs aren't still doing well yet, you need to first understand how REITs borrow money. When REITs borrow money, they borrow at the current rate, and then they lock in those rates for 2 to 5 years. This means even if interest rates have come down today, a REIT that borrowed in 2022 may still be paying that high rate today. Take CICT for example. Their average term to maturity is at 4 years, and they have a weighted average cost of debt of 2.9%. That's a 1.7 percentage point gap from the current SORA rates. Or FCT, the bulk of their debts are only going to mature in 2029, and right now, their average cost of debt is at 3.2%. Or MPAC, the trust behind VivoCity and Harbourfront Centre, it has an average cost of debt of 3.16% and a weighted average debt maturity of 3 years. So the longer a REIT's average debt maturity, the longer it is stuck paying those high rates. And if you plot the weighted average debt maturity, or WADM, to the dividend growth over the past 1 year, you will start to notice a pattern. For example, OUE REITs has a shorter WADM, so their fixed rate loans expire earlier. As a result, they were able to refinance at lower rates and pass on more savings in the form of DPU to their unit holders. ESR Logos REITs is another example. They have a 2-year WADM, and after the rates came down, they were able to increase their DPU by 7.6%. Same for Suntec REITs, which has a short WADM, and as a result, they were able to increase their DPU after refinancing at lower rates. However, if WADM was able to explain everything, you expect the entire right side, aka the REITs with longer debt maturities, to be either flat or declining. While some of them are indeed going down, there are also some REITs that are able to grow their DPU just as much as the REITs on the left side. And there are two reasons for that. The first one is geography. When Singapore lowers its interest rate, it only lowers the cost of loans on Singapore properties. So if a REIT owns properties in China, Hong Kong, Australia or Europe, those assets will have to deal with their own local market conditions. One such example is Mapletree Logistics Trust, or MLT. It has about 20% of its portfolio in Singapore, while the rest is spread across Asia with roughly 18% in China logistics. And right now, China is having a massive logistics oversupply, where the vacancies are rising and rents are falling. So even though the REITs savings on their Singapore dollar loans are real, they are also getting affected by the falling rental income from the China properties. Meanwhile, MPAC is a different story. Their Singapore properties are doing well. VivoCity alone grew its rental by 14%, but their overseas side is dragging. In Hong Kong, their Festival Walk Mall is dealing with weaker consumer spending as more residents are crossing into Guangdong to shop instead. In China, their office parks are facing rising vacancies as corporates cut back on space. And in Japan, even though the properties are stable, the yen has been weak. So when the rent gets converted into Singapore properties, you end up with less. So even though the cost of debt has come down to 3.16%, those savings are getting cancelled by the overseas drag. Likewise, the Frasers Logistics and Commercial Trust has most of its portfolio in Australia and Europe, and only a small portion in Singapore. So when the Australian dollar and the euro fall against the Singapore dollar, the same overseas earnings translates to fewer Singapore dollars by the time they reach unit holders. So when you plot all of it out, you can see that most of the REITs with high Singapore exposure are able to grow their DPU, while the ones with heavy overseas exposure are a lot more mixed. Now, if you want to start investing, you need to keep your costs low. That's why I use Interactive Brokers. With Interactive Brokers, you are paying just 35 cents per trade on the US stock market. That's one of the lowest in the industry. They also give you access to Ireland domiciled ETFs, which can save you a chunk of dividend withholding taxes. And if you are not sure what to invest in, they also have a bunch of free company research tools built right into the platform, so you can do your homework before putting your hard-earned money in. Check out my link in the description to get started. Alright, now back to the video. Now, besides geography, there's also another reason why some of these long WADM REITs are doing well. For example, even though Keppel DC REITs has a WADM of 3.3 years, it was able to grow its DPU by 9.8%. Parkway Life REIT, 3.8 years, DPU up 2.5%. CICT, 4 years, DPU up 6.4%. FCT, 3.9 years, DPU up 1.4%. So if we apply the WADM logic to these names, they should be underperforming. And yet, they are some of the best performers in the sector. The reason is that the type of properties they own is in such high demand that their REIT savings become almost irrelevant. Take for example, KPLDC REIT is a data center REIT, and right now we are in an AI boom where every tech company in the world needs more data center capacity for AI. So when tenants are lining up at your door desperate for space, half a percentage point of your borrowing cost becomes irrelevant. Meanwhile, Parkway Life REIT is a healthcare REIT where they own hospitals in Singapore and nursing homes in Japan and France. 79% of the portfolio is overseas. But unlike MLT's China exposure, which is dealing with oversupply and falling rents, Japanese hospitals don't have a vacancy problem. Instead, every single one of the properties is on a long-term lease tied to inflation. So the rent goes up automatically every year regardless of what the rates are doing. And because most of the borrowings are in the Japanese yen at near zero rates, their all-in cost of debt is just 1.6%, which is one of the cheapest in the sector. As for CICT, 94% of its portfolio is in Singapore. And because Singapore's office supply has been limited and demand has held up, CICT was able to reprice its expiring leases to current market rates and grow its revenue by 8%, with rents going up 4.4% on retail and 6.1% on office when leases renews. As for FCT, even though the bulk of its debt doesn't expire until 2029, and their cost of debt is still at 3.2%, their suburban malls are full of supermarkets, clinics, and heartland hawker centers. These are the kind of tenants that people visit every week regardless of the economy. That captive footfall is what keeps its occupancy rates high, while giving FCT the pricing power to keep raising rents, or without needing any help from falling rates. But here's the part most people miss. All of them are already doing well, even though their rates savings haven't arrived yet. So when those fixed rate locks eventually expire in 2027 and 2028, they will get a second boost on top of income that is already growing. For example, when the bulk of CICT's debt expires in 2028 and 2029, even a 0.5 percentage point drop in borrowing costs across nearly $10 billion in debt is a meaningful boost to the payouts per unit without needing any improvement in the properties. Same for Parkway Life, where a large percentage of the debt expires from 2026 to 2028. So when those fixed rate hedges roll off and they refinance, they will get an additional tailwind layer on. As for other names, well, it's a little more conditional. Both MLT and MPAT have their rate savings coming as the debt rolls off. But the bigger variable is the overseas property cycle. For MLT, it will depend on whether China logistics oversupply is able to clear, and for MPAT is whether Hong Kong retail and China commercial properties recover. If those cycles turn, they will each get a rate tailwind and a property recovery at the same time. But whether they will come true or not, and when, we will just have to wait and see. In short, no, REIT investing isn't dead, but you need to know what you are actually looking at. The ones that haven't recovered aren't all broken. They are either waiting for high rate debts to roll off or dealing with overseas property cycles that have nothing to do with Singapore rates. But perhaps the most interesting setups are the ones where the business is already growing despite having higher rates. That's because when those fixed rate locks eventually expire, they will get a second wave of savings coming on top of income that's already moving up. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.